Good day and welcome to this risk readiness webinar. My name is Carly Edmondson and I am the Senior Product Manager of Business Solutions at the Risk Management Association. RMA is proud to make this presentation complimentary to members. If you're not a member, explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending Credit Risk Navigator presented by Tom Cronin from AFS. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We will address as many of your questions as we can at the end of the presentation. So usually I would flip it right over to Tom now, but we're going to change things up a little bit and start with a poll question. Specifically, what are your commercial customers' top concerns at this time? So you can choose multiple, but based on those conversations that you're having with your customers, what are some of the main concerns that they have been expressing to you? So while we let people go ahead and respond to that, I will go ahead and flip it over to Tom. Thanks for being with us today, Tom.
Well, thanks, Carly. And welcome to everyone joining us today. As I assume, as we'll see in a second, at the result of the poll question, there's a lot going on. High inflation, supply chain problems, rising interest rates, and now just read today a decline in the GDP. So we're going to see how all these headwinds have impacted the performance statistics on our database. And I think we're in for a few surprises today. The source of our data today is the Credit Risk Navigator, the RMA Credit Risk Navigator powered by AFS. And CRN.
Sorry, I went ahead and.
That's all right. That's all right.
You can see what the results are. Definitely supply chain issues and inflation are pretty big hot ticket items. So I'll let you continue, Tom.
Okay. No problem. It was good to know that. So let me close it. So Credit Risk Navigator is the largest monthly commercial loan credit risk database in the US. It provides performance data that can be segmented by things such as collateral, industry, and geography, just to name a few. And the database has been independently verified to be regionally representative and a statistically viable indicator of loan performance for the commercial loan market. And just in terms of size, the commercial loan portfolios of the member banks range in size from 2 billion to a little over 100 billion. All right. So we're going to start the data review with the C&I or commercial industrial review. Just a quick definition. These are loans for business purposes, usually to companies with annual sales north of $1 million. They are manually underwritten and risk rated, so no auto decision loans in here. And loans that are secured by owner-occupied real estate are in C&I. So let's start with non-accruals. This is our performance chart. We're going to start with non-accruals. And for March 2022, the percent non-accruing was 0.56%. And we haven't been that low since 2007. So we're lower than where we were after the recession, and we're lower than where we were after the energy crisis. And in a minute, we'll take a more detailed look at the non-accruals by industry and by region, because the improvement is not universal, but I want to touch on delinquencies. So delinquencies, as you can see here by the greenish line, continue to fluctuate. And this month, all three delinquency measures are back up, not only the greenish line, but the gold and the dark green. And since late 2020, we seem to have been stuck in a 10 basis points plus or minus around 50% with the short-term delinquencies. And I hadn't planned on showing any detailed information on past dues, but when I saw this chart, I thought it's perfect for describing what's been happening with past dues since March of 2020. And just a quick note, You're going to see a number of these charts or charts like this today with March 20, March 21, March 22. And as I mentioned last month, this structure was suggested by Brooks Brady from Zions Bank. So thanks again to Brooks and to all the other CRN users that recommend unique and useful ways to view the data. So you can easily see the variations throughout this chart. You have sectors such as 22 utilities, 31 manufacturing, 48 transportation, just to point out a few, that have wild swings in the past dues. And this is repeated for almost every sector here. And while non-accruals have improved to pre-recession levels, delinquencies remain a bit high. And as we said, fluctuate significantly month versus month and industry sector versus industry sector. And in canvassing the CRN members, what we're finding is that the economic events we mentioned at the start and that you pointed out are responsible for this volatility. For example, a given borrower might have an issue with getting the right supplies and falls behind for a short period of time before they can complete the project. So the issue is not prolonged or severe enough to move the company into non-accrual. It's just a temporary setback and is causing these swings in past dues. So now we'll move on to the non-accruals. And what we sort of tag these three periods, March 20 is obviously pre-pandemic. March 21 is right in the middle of the pandemic. And now we're here at March 2022. I'm not sure if we'll call this the end or Stephen Martin from the RMA called it the first end. So we'll try that. And there's a lot to digest here. So I tried to categorize the movements into a couple of groupings. The first group, and there are 12 of these industries, are sectors that had an increase in 2021 when compared with 20, and then a decrease in 2022. And examples of that are 21, mining, oil and gas, and then 71, arts, entertainment, and recreation. These are the sectors that were negatively impacted by the pandemic closures, but have since rebounded. And many are now better than they were in 2020. The second group, slightly smaller group, 7, were not impacted at all by the pandemic restrictions. This group actually had a decrease in 21 and then another decrease in 22. So those examples of those would be 42 wholesale and 61 educational services. And then we have a third group, and there's only 5 of these, so I'm going to mention each one. These had a decrease in 21 from 20, but it followed that with an increase in 22. So they've come out of the pandemic worse than they started. Those 5 are 11 agriculture, which is now the highest percent non-accruing sector, 23 construction, 33 manufacturing, which we've talked a little bit about in the last couple of webcasts, 54 professional, scientific and technical services, and then technically 62 health, although that increase is basically flat. There's really not much there. So let's take a further look at some of these sectors. And here we're looking at the 5 sectors with the highest percent non-accruals as of March 2022. And this chart is another suggestion from an attendee who completed the survey at the end of the last webcast. So I'll just put that out there. If you want to see something in a particular fashion, there is a survey at the end and you can make some recommendations there. So the historical non-accrual performance for the current 5 worst performing industries is shown here, with the maximum being at the top of the line, the minimum is at the bottom of each line, and the marker is the current level. And these sectors are substantially above the overall market as of March 2022, again being the 5 highest. But with one exception, they are near their historical low points. The exception is 11 agriculture, which has been rising and is now approaching the service level highs we saw back in June of 2010. You can see the others are all down near their bottom point. And so even though they're bad, historically, they're not as bad. They're not as bad as they have been in the past for historical purposes. All right. So I wanted to take a second for the CRN users. to show you how I was able to use the dashboard to pull these numbers. And here's a shot of our executive summary. And I've selected the percent non-accruing tile you see in the middle. And to get the historical values, you go to the filter selection on the right-hand side of the screen. You open that, select industry, drill down, pick 21. In this case, I just picked 21 and hit apply. And you can see here's the result. So the bank numbers in the blue, so this particular bank didn't have any delinquency or non-accruals for oil and gas, but the market is in the yellow, and you can see what the results are. And then you can hit this export data icon, and that'll allow you to export your data to Excel and create that chart I just did. So let's go back to our results. And again, we're talking about agriculture. So as I said, agriculture is now the worst performing industry when looking at non-accrual levels. Not all the agricultural sectors are performing poorly, but unfortunately, the two largest subsectors, crop production and animal production, display above average non-accrual levels. This is all the result of increased costs for needed technology, the severe drought conditions, especially in the West, along with increased diesel fuel costs and fertilizer costs are causing havoc for farmers. And smaller farms have been disappearing at rates faster than we've ever experienced. Within crop production, we're seeing elevated non-accrual levels for growing corn. And within animal production, the highest non-accrual levels are for dairy and egg production. So let's complete our review of ag by looking at the regions with the highest level of non-accruals. So this is agriculture again by region. And when we say region, we mean where is the borrower located. So you don't see the Northeast on here. The Northeast is actually the highest, but the outstandings were very small. So I did not include that here. That's why they're not here. What's here are the regions that have some relevance, if you would. The highest is the Mid-Atlantic. And this is seeing elevated levels of non-accrual for egg producers in the state of Pennsylvania. The Eastern Midwest is the next highest. That's having problem with oilseed growers. The West is the next, and that's having issues with dairy farming in Idaho. And then the Western Midwest, all the way down there at the end, is having problems with corn producers in Iowa. So I've mentioned the drought, pardon me, and I just wanted to show you exactly what we're talking about. So this is the drought monitor from the USDA, and just gives you an idea of how bad it is. I'm here on the East Coast, and I'm cutting my grass probably 3 times a week, and so I'm not really familiar with what's going on. But you can see west of the Mississippi, the deepest red in parts of Texas and Nevada and Oregon, and then the second, what they're calling extreme drought in the California Agricultural Valley, throughout much of Oregon, up into Montana, and then again, Texas and Oklahoma. So this is just information so you kind of get a feel for how bad it really is. So now we're back to looking at non-accrual levels for the entire portfolio, and again, by geographic region and by the March 2021-22 scenario. And for most of the regions, when you look at the results spanning 2021-22, 21 was a bad year, but 22 was a better year. And for every region except one, the non-accrual level as of March 22 is better than what it was as of March 20. So not only have you recovered, you've recovered better than you were before. The only exception to this is the Eastern Midwest. Non-accruals have improved 22 versus 21, but the percent for 22 is not yet back to what it was for 20. And again, this is the only one that's different here. And so far, the biggest drag in the Eastern Midwest is for 33 manufacturing. And within that, we're seeing additional problems for motor vehicle parts manufacturing. So now we're going to move on to credit quality. And we measure credit quality by the risk rating. And just some quick background. When we load a bank's data into CRN, we mapped their borrower risk rating, into the RMA 10-point scale. On that scale, borrowers rated 1 through 6 are pass. Borrowers 7 through 10 are criticized, with the following splits: 7 being special mention, 8 being substandard, 9 being doubtful, and 10 being loss. So we're seeing an improvement in the criticized levels. Those are, again, the loans rated special mention, substandard, doubtful, and loss, but it appears to have leveled off the last couple of months. If you go back to early 2020, the beginning of the pandemic, you'll remember that banks were unsure how their borrowers were going to fare, and they moved a substantial amount of their portfolios to special mention. That's the dark blue. And you can see it go above 5% there in early 2020. Now, much of the uncertainty has passed as companies have learned to cope with COVID, and many of the special mention loans have been returned to pass status. And as of March 2022, the overall credit quality is actually better than what we saw before the recession. So let's look at the total credit quality spectrum. And here's the full RMA 10-point scale distribution. And not to state the obvious, but we have 2 movements here. First, 20 to 21, you see a drop in the 2s, 3s, and 4s, all moving to 5s, 6s, 7s, and 8s. Then 21 to 22, we go back the other way. We move back to pass and the better ratings. But unlike non-accruing, if you remember, non-accruing's return to pre-recession levels, we're not really seeing yet the return to the 2020 levels. The 5s remain elevated and the predominant rating. The 4s and 5s, 4s and 3s and 2s have recovered, but not to where they were. And I believe the movement in 2022 is to the better, but not the best ratings, is due to the uncertainties that we discussed throughout the presentation. There's just still too much unknown to move back to where we were pre-pandemic. So one last C&I slide. Here we're displaying the change in outstanding balances for each 2-digit NAICS code, and we're looking at just the past quarter. So December 21 versus March of 22. And there's almost an even split between the gainers and the losers, if you would. But what I found the most interesting here is this. If we remember our historical high-low chart for the 5 highest non-accruing sectors, 4 of those 5 are here and in the decline bucket. And this would seem to be logical. You know, why would you grow loans for a sector that is not performing? But from time to time, we have experienced growth for sectors that illustrate performance issues. But it seems now people are being very cognizant of what's doing well and what isn't, and staying out of the bad. Also of interest is the highest growth here on the far left is for 42 wholesale. And to me, that would seem to indicate that companies are gearing up inventory levels with the idea that consumer purchasing is going to rise. So I would view that as a good sign. Now we're going to move on to commercial real estate. And a quick definition, this is also often referred to as investor-owned real estate. Matter of fact, in the CRN product, you'll see it, we call it investor-owned real estate. We follow the interagency guidelines in what becomes commercial real estate, basically saying that a loan payment comes from the sale or lease of the properties. All right.
And we have a poll question for this one as well. And it is, what are your expectations for your CRE portfolio? I guess I probably should have included in terms of growth. To reduce slightly, hold steady, grow slightly, or grow significantly. We'll wait until about 50% have participated, and then I'll go ahead and end the poll and launch the results. Still have some people coming in. Okay, right, 50%. So it looks like grow slightly. There's kind of runs the gamut, but looks like grow slightly is definitely the majority of folks that are on the call. So Tom can share now with us whether or not that's a good idea.
All right. Thanks, Carly. I almost forgot we had that one. Um, so this is the performance for CRE. Um, and again, non-accruals and past dues. And here, unlike what we saw with C&I, we actually see an uptick for the non-accrual and the short-term past due levels, if you look March versus February. But I don't think this is an indicator of a negative trend, at least when we're talking about the non-accruals. And let me explain. Um, since we reached a pandemic high of 1.28% in January of 2021, the overall direction of the non-accrual rate has been trending down or improving. And we've actually had 3 periods where it jumps up. But after each increase, it's resumed its movement back towards pre-pandemic levels. Now, unlike C&I non-accruals, which are at pre-recession levels, the CRE non-accrual levels remain elevated when compared to the 2019 levels, but I think we're starting to get there. It's just not going as fast as C&I. And if you remember, when we were talking about CRE back in 2021, it actually started getting worse than C&I. It started getting worse from the pandemic after C&I. So it looks like C&I has been and still remains, is a little bit ahead of the game when you compare it with CRE. So let's delve a little deeper and see what's holding back these numbers. So here's non-accrual by property type. And for anyone who's new or people who are have been on with us before and need a reminder, I've picked the 8 property types for this slide that are the largest property types in CRN, with largest equal to the highest amount of outstandings. Now, lodging is and has been the worst performing property type during the pandemic period. It topped out at 9.5% in June of 2021 and now sits at 5.73. So it's come down quite a bit. Unfortunately, during the time period that we're displaying here, lodging is the only property type that's shown any significant improvement. In fact, we saw increases in non-accrual levels for several of the other types, including a rather substantial increase or rise for mixed-use properties. Office properties and retail properties are also up. The amounts, and I don't want to be dramatic because the amounts that are increasing are actually very small. And as I suggested in the previous slide, are probably just temporary movements, but we're going to keep an eye on this, especially the office. There was an article in the Wall Street Journal that mentioned how many, a large portion of office leases were going to expire in 2022. And we can now begin to see the full impact of working remotely as companies return, but it may be a smaller footprint. I'd also point out that there were some comments with the new CEO of Fifth Third and the American Banker, where they said they were scaling back on commercial real estate, especially with office and the return to work. So I recognize that my comments contain a lot of speculation here regarding what's going on with commercial real estate. And I wish I could tell you the non-accrual rate for property X will be Y by June. But as we've noted in the poll at the beginning of the webcast, there's just a lot of unknowns and concerns that I think would make any predictions very questionable. So I'm just going to stay away from anything right now. So here's the risk rating mix for the CRE loans. And this is set up the same way that we did for the C&I loans. The results are similar, but there are some major differences. So for 21 versus 20, we see a more severe shift to the right and the higher ratings. So there's more, and again, I'm comparing it with C&I, there's more 6, 7s and 8s and less 3, 4s and 5s. If you recall the shift, the C&I shift saw basically an increase in 5s, not so many increases in the 7 and 8s. Then for 22 versus 21, we're again moving back to the left and the better ratings, but you see the 8s haven't dropped all that much. So the 7s, which are special mentions, drop, but a lot of these 8s, which are substandard, have seemed to have stuck around. So I thought it'd be interesting to see what's happening there. So we'll go to the next slide. And let me explain what I did here. Pardon me. So I took the entire balance of loans rated 8 for each time period, and divided them by the amount of outstandings or past the amount that was risk rated 8 for each property type for each time period. As an example, if you look at healthcare on the far left, so 6% of the loans rated 8 were the healthcare properties in March of 2020. Just under 20% other loans rated 8 were for industrial properties, etc. So in 2020, no single property dominated the rating of 8. For 2021, however, lodging comprised more than 50% of the 8s, and not surprisingly, all the other property types dropped. Lodging continues to be the primary property type that is rated 8, but given our comments when examining the non-accruals, I think it's interesting to see that that office properties are beginning to rise. Maybe there is some logic or some reason behind the concern that the Fifth Third CEO mentioned. So here we show the change in balances for December 21 versus March of 2022, and we're not seeing much growth. If I take this quarterly outstandings here and project it for the year, that shows an annual growth of less than 3%. Contrast that with what we saw with C&I, March versus February, where we saw almost 13% annual growth. And also, we're seeing slow or no growth in some of the hotter property types, like industrial and multifamily. And we've canvassed our participants and listened to a number of investor presentations, and we haven't really found or heard of a single reason for why industrial and multifamilies are down. It just appears to be that there's an overall cautious approach to how banks are looking at property types, commercial real estate in general, and specific property types. So if anybody had any idea of what's going on here, we'd appreciate a note, maybe send us an email and let us know what you think might be happening there. So that's it. That's the end of what we had to offer today. Carly, I guess I'll turn it back to you to see if there's any questions.
Great. Well, please feel free. We still have some extra time, so please go ahead and use the Q&A button or box if you have any specific Q&A questions. We do have one, Tom. Is there any insight on the increase in non-accrual in construction? Is construction broad across residential and commercial?
So it's definitely commercial. And so I know that much. Beyond that, as to why it's dropping, I don't know. And I say I don't know. I don't know specifically. I think what we have speculated, Carly, is that a lot of this has to do with supply chains.
Yeah,
that people just aren't getting the supplies, the material to complete their projects, to finish the whatever they're working on. It just really seems to be hitting them hard now.
Absolutely. I think those supply chain issues are a huge problem, especially as it relates to commercial construction, the types of materials that are required for that. So we can stay on a little bit. If there's any more Q&A, definitely please feel free. Oh, here we go. Is the different performance of CRE due to the eviction moratorium?
So I do not think so. I think you would have seen that impact the residential side and on some consumer issues. But this, it doesn't look like it, because a lot of it is, obviously lodging is the biggest one, and then offices. So it's areas that are not impacted by that, the moratorium being lifted.
Got another question in. Can you provide any color on the regulator's guidance to come on climate risk?
So Jeremy, are you still on the line?
And what was the question again, please?
Can you provide any color on the regulator's guidance that is expected to come on climate risk?
Yeah, that's a great question. I know More recently, the SEC recently put out some guidance, as did the OCC. I know that the U.S. regulators are trying to play catch up a little bit with their European counterparts. I think it's still a little bit too soon to figure out what this all means. I think all the signs are pointing to eventually the introduction of climate stress testing here in the US, where there might be a capital surcharge associated with quote unquote brown assets, or lending to oil and gas borrowers. Definitely pay attention to future webinars. I know this is a very important topic and one that's developing very quickly, but in the immediate term, I'd point you in the direction of the recent rule by the SEC about climate disclosures for companies and what that might mean for banks in terms of how they disclose the level of emissions they're financing.
Great, thanks, Jeremy. And I'll say as an RMA plug in general, RMA has been doing a ton on climate, so definitely recommend checking out our website, rmahq.org. And we have pretty consistent resources as it relates to climate, our climate risk consortium. So there's a lot of really good information on the website as well. So we have another question. Any color regarding the increase in mixed use non-accruals?
Yeah, so I don't have any specific data, but what I've heard is that the mixed use properties where there's office involved, so it might be retail on the bottom and then office up above, those are the ones that are having problems. The mixed use that have retail on the bottom and multifamily or apartments up on the top, those seem to be doing well. Again, it looks like an office related issue.
Thank you. We have, let's see, another question. Are the hospitality challenges more in the business related hotels like conference centers versus destination hotels or standard travel hotels? Yeah, go ahead on that.
Go ahead. Yeah, so it is the conference centers, the business related. I did not show it here, but a few months back we pulled up lodging by region, and CRN has the ability to go down to the CBSA level, and we could see that the highest level of non-accruals were in New York, Boston, DC, and I believe San Francisco. So all business conference center type areas, whereas you see very little past dues and non-accruals in the Hampton Inns that located on the turnpikes and things like that. So it's definitely business related travel being off and not having in-person conferences.
Definitely, yeah, we've heard a lot of that. Those destination hotels and resort and type of things, those are all for the most part doing really well. So definitely those conference centers. Another question on the C&I slide about non-accruals, the 30 to 59 day moves up and down a lot over the last 2 years. It seemed to do the same thing right before the Great Recession. Is there a reason that stat moves so much? That stat's moving so much now or back in 07, 08?
So I'll take the second part first. So 07, 08, it moved because everything was starting to go bad. And from what the work that we've done in looking at the recession, just about every industry was impacted. It was bad for everybody, and the rates just started going up, and there was a lot of volatility. For the current period of time, as I was trying to mention as we went through this, it seems for some reason we're stuck in that, around 50 basis points going up 10, up and down 10 minus that. And Carly, you might remember you and I had talked about this. We both firmly believe and have heard that this is due to the supply chain issues. It's just people aren't being able to get things fast enough to complete projects, to complete build outs of things. And so they're getting a little bit behind. And it might happen 1 month and then the next month they're back in business. It's just a really strange period. And until it gets solved and the supply chain issues get solved, who knows where this is going to go.
Yep, it's been volatile, that's for sure. So any other questions? Those were great questions. Thank you so much to the folks who answered or who wrote in. Well, I guess in the meantime, if you have any last minute questions, please go ahead and put them in. But I would like to thank both Tom and Jeremy for sharing your insights, and thank you to everyone for joining us today. If you are interested in learning more about Credit Risk Navigator and how it can provide deep insights like the ones presented today, please reach out to Tom, myself, or your RMA relationship manager, and we'd be happy to discuss with you. We look forward to having you at our next session on credit trends. And if you were unable to join the live demo that we did on the new interface a few months ago, make sure to watch that on demand by visiting rmahq.org. We have another question that came in. How are the work from home strategies expected to impact the appetite for leasing of CRE? How has it impacted that appetite up until today?
So up until today, and again, this is another topic we've talked quite a bit about, we've seen very little impact because most of the office leases are long-term and they just haven't run out. But as I mentioned, the article in the Wall Street Journal, and I apologize for not knowing the exact date that it was in there. They said a very large and unprecedentedly large number of leases are coming due in 2022. And they expect that people will either not renew them or renew them at lesser square footage. I'll give you a perfect example. Our colleagues here at RMA are currently at 8th and Market. I believe in August you're moving, Carly?
Mm-hmm.
And from what I've heard, you're moving into smaller space.
Yes.
So it's not that everybody's going to work from home. It's just not as many people are going to work from home. There will be companies, that will make people come back to their offices and take office space. But I think overall, you're going to find a net reduction in the number of square feet. So similar to what the CEO of Fifth Third echoed or mentioned, I think there's a concern for office space, and I believe you're going to start to see that this year, towards the end of this year.
Absolutely. Okay, well, I guess I already did my outro, so thank you again. That concludes our webinar. Really appreciate everyone taking the time today, and we look forward to seeing you next month. Thanks.
Thank you.
Take care.
Bye.